Chapter 9, the Capital Asset Pricing Model. The Capital Asset Pricing Model is a model that we can use to describe the returns of an individual asset or an individual stock or a portfolio using the return of the market as a priced factor. And so chapters 8, 9, and 10 in the text cover factor models. So let's just do an overview of factor models, and then we'll move into the specific model that we're going to talk about first, which is the capital asset pricing model. So a factor is something that explains asset returns. If a factor explains returns, it's said to be a priced factor. And we'll look at statistically how we can determine whether or not there actually is a relationship. If a factor explains returns, it's a price factor. Since returns are changes in prices, the terminology is that a factor explains prices or it's a priced factor, but really we mean it explains returns, which is the change in price. The factor load is the relationship between the factor and the asset return or the asset price. And again, this is measured by the factor beta. In general, we'll distinguish between general betas, which is the second letter of the Greek alphabet and used to describe these linear relationships, these coefficients, and a specific application of factor models, which is the CAPM beta. Generally, if someone refers to beta and they don't qualify it, they usually mean the capital asset pricing model beta, as opposed to just the general use of any factor load, which would be betas in general. So here are the types of factor models. The first is a single factor model. If you choose to have just a single factor describe prices, then this is a factor model. A subset of factor models is if the factor you have chosen is an index, then we refer to this as an index model. And this is fully described in chapter 8, along with a lot of regression math. Next, if that factor is an index, and that index is the market index, then this is a specific type of single factor index model, the capital asset pricing model. And chapter 9 delves into this. Finally, if you choose multiple factors to explain returns, the size of a stock or the relative price, or if it's the case that you're going to use energy prices or currencies or any sort of commodity price, then you might have a multi-factor model, and you'll have more than one beta, and this is described in chapter 10. And so we will go through this material in the order of chapter 9 first. We'll look at the capital asset pricing model and the applications of the capital asset pricing model. Then we'll go back and we'll do the math in chapter 8. And then we'll move on to chapter 10, which is the arbitrage pricing theory. So chapter 10 is called the arbitrage pricing theory because, and here's sort of the underlying idea, if an asset has multiple priced factors, if multiple things can explain the price changes or returns, then the assumption is an asset's return can be replicated by investing in these multiple factors at these factor loads. And therefore, one can earn an arbitrage profit by taking a position in the mispriced asset, either long or short, and then taking a simultaneous offsetting position in these factors and earn what is, in theory, an arbitrage. We're going to do the application in a slightly different way. We're really just going to look at multiple factors to try to figure out what risks there are associated with a securities or portfolio's returns. So what we'll do in this class is we'll do chapter 9 first, the capital asset pricing model. We'll talk about what it is, we'll talk about what it isn't, we'll do a quick sketch of the derivation. We're going to skip a lot of the math for the proofs of the CAPM. We'll talk about the three main results of the capital asset pricing model. We'll estimate the CAPM beta using returns data. And then we'll talk about the graphical representation of the capital asset pricing model, which is referred to as the security market line or the SML. And then we'll do a few extensions. Next, we'll move back to chapter 8. And in chapter 8, we'll look at general index models. We'll do a little bit more regression math and statistics. This will give us an opportunity to introduce something called the tracking error and the information ratio, which are very commonly used methods of assessing a portfolio's risk. And then finally, we'll move on to the chapter 10 material, multi-factor models and multiple regressions.